What's up, guys? Feeling a little poor today? Let me show you a new skill that might help you with that. So, today we're going to look at a stock screener called Simply Wall Street. It's up here on the top left, but just to show you, I'll type it into the search bar. Um, so, when you first get here, it's going to start you off, and you'll probably be on the dashboard. You can see at the bottom left where you probably want to go first while you get used to this thing is let's go over to the Discover tab, which is the light bulb. And this area will give you some ideas for some types of stocks that you might want to look for. There's all sorts of stuff to choose from in here. Me personally, I would probably come to something like undervalued stocks based on cash flows because I like dividend stocks, so we're going to go there. And we're going to pick this first company called Central Pacific Financial, and they are a bank holding company. So, this thing on the right, this circular chart, as you can see, it's like a blob. I think they call it a big green snowflake. And so that means just right off the bat, looking at this, it's a pretty healthy company. It shows you different metrics: value, future, past, health, and dividend. And so the further that green snowflake is pointed towards each of those categories, it means the better that it is with that criteria. So you can see it's pretty healthy, valuation's fair, future earnings potential is pretty high, dividends decent. So this is a decent all-around company according to that snowflake chart. And you can see here it says trading at 50% below our estimate of its fair value. That's really good. Earnings are forecast to grow 20.83% per year. Pays a reliable dividend of 4.15%. And guys, dividends are very, um, what's the word I'm looking for? They're just not as appreciated as much as they should be. A lot of people are really interested in growth stocks and tend to neglect dividend stocks. But guys, I'm telling you, if you neglect dividend stocks, you're missing out on a lot of potential gains. But anyway, we're going to go take a look at valuation. Um, Below fair value and significantly below fair value, but some of these other metrics aren't quite as good. PE ratio, let's see. Um, Price to earnings compared to peers, a little bit higher. That still doesn't look too bad to me personally, but sometimes you can forgive a slightly higher PE ratio if it's a really good company with uh, a lot of future earnings potential. And speaking of which, we'll go to future next. Um, and you can look at this future criteria. It says revenue growth is not considered high, but 12%, especially in today's market, I would consider decent. And that annual earnings growth rate looks pretty good to me as well. And then you can see there's some more criteria down here. So high growth revenue is the only thing that has the X. Green check marks are good, X's are bad. Um, Earnings per share growth forecasts continually going up, so that's good. Past, you know, past can be important, and I mean it's good to look at, but to me it's not one of the more important categories. So we're going to skip on to health. Um, and as you can see, one thing you'll notice about banks when you look at banks, most of them tend to be pretty healthy, tend to be pretty financially responsible. So the only downside is near term their assets are 314 million compared to liabilities of 7 billion, but long term assets are 7 billion and liabilities are 237 million. So that means down the road things should be better from a balance sheet perspective on this stock. Um, Now let's go to dividend. Take a look at that. So dividend's not considered high, but it's notable, stable, growing, and future dividend coverage. I mean, I guess nobody really knows for sure what the future of a dividend is, but to me this looks pretty good. I mean, it's grown over time, so that's a good thing. Um, it's stable, And compared to the broader market, it looks like the dividends in the maybe the top 25% of the market industry average is only 2.7%, whereas this company's 4.2%. So, a lot of good looking stuff here. Another section that I like to check out is this management section. Tells you a little bit about the CEO and maybe some of the other executive leadership. And as you can see, the CEO's compensation, this first part has a green check mark, below average for companies of similar size, but then compensation versus earnings, it says his compensation has increased by more than 20% in the past year. So if I was a shareholder, that would concern me a little bit. I'd want to stay on top of that. It's not that you want people to be well paid, but at the same time, you want it to not be too big of a chunk of the company's earnings, and you want to make sure that the dividend is safe for shareholders. And you can see it even tells you what some of the leadership makes as far as estimated compensation packages. But the thing that I really like about this screener is you can see the ownership breakdown from institutions to individual insiders and the general public. It tells you how much ownership each has. You can see institutions own 93% of it right now, which is a lot. And of course, at almost 15% is BlackRock up at the top. You'll be seeing a lot of BlackRock and Vanguard and State Street Global. Several of these guys manage some large ETFs, exchange traded fund. If you don't know what an ETF is, I highly encourage you to look into those. Those are very popular investing tools. Number of employees. So, again, a lot of good information on the stock screener. I highly encourage you to check it out. Now, a little disclaimer, this thing is very limited as far as the free plan goes. So in order to get a lot of good use out of it, there are paid plans that you can do. But if you plan to get into investing in the stock market, I highly recommend this app, especially if you want to be a long-term investor, which I would recommend over trying to be some kind of day trader. But guys, if this helped you out and you enjoy this content, I'd appreciate it if you'd like the video and subscribe to the channel if you want more content like this. But thanks for joining.